Hello everyone, welcome to our Egyptian online seminar group. First, keep your microphones off. Then, if you have any questions, you can ask our speaker during his presentation or after his presentation. I have great pleasure of welcoming here Professor Martin Jacob. Professor Martin Jacob holds the chair of finance, accounting, and taxation at WHU Otto Beisheim School of Management. He received his undergraduate degree in business administration and his doctoral degree from the University of Tübingen in Germany. His research focused on economic effects of taxations on business decisions. His work has been published in several leading international journals, including the Journal of Financial Economics, the Journal of Accounting Research, the Review of Financial Studies, the Accounting Review, the Journal of Accounting and Economics, Management Science, and the Journal of Public Economics. He serves as associate editor of the European Accounting Review and Accounting and Business Research. Since 2021, Martin Jacob is a member of the Scientific Advisory Board of the German Ministry of Finance. Now we will start our seminar with dear Professor Martin Jacob.
Well, many thanks for the kind invitation and also the introduction. I hope that everyone can hear me. Yeah, excellent, good. So I was really honored by the invitation and many thanks for organizing this. And the way I see it here, it is quite a global event. I see co-authors from the Netherlands. I see other people from the Netherlands. I see Nathan here from the US. You brought people together from around the globe. Professor Easton is here. Many thanks for this. Again, as was already said, I am very happy to take questions, of course, at any point in time, right? There's no need to wait when anything is unclear. Let's keep it as a normal seminar. Feel free to ask questions at any point in time. And also already maybe a little disclaimer, if you happen to have any suggestions, of course, they are way more than welcome, because this is a project together with Kira, who's also here in the seminar. And we literally started last summer with the project. So it is fairly early. So any comments are more than welcome. So let me maybe get started. What is it that we do here? We talk about something that we believe becomes more and more important: environmental taxes. And what we want to look at in this paper is the role that these environmental taxes, we look at very specific ones, play in corporate investment. This is, of course, by far not, let's say, the end of potential analyses that one can run, but we think it is a start. And why do we think that this is important? I mean, I can say that personally, I was intrigued to do something like this when we had the election campaign of the federal election in Germany popping up. And they asked the three candidates in Germany, what do you do with the environment? And then they all said, yeah, we need to increase taxes, or we need to increase prices on carbon dioxide and so on. And then they asked them, and who will pay the price? And in the end, everyone said no one. Yeah, so they wanted to increase taxes and give it back. And I was sitting there and it's like, how can you do something and give it back and then think that it has an effect? It sounds too good to be true. So I thought that maybe we can start informing that debate by looking at how such taxes, and we specifically look at emissions, affect investment. And then we also went back and looked at some policy quotes from some years ago, some recent ones, and they usually do something like that: we want to have appropriate green taxes, and we want to ensure that those who pollute or waste the most, they bear the consequences of that tax. Now, that's what the European Commission says. The OECD said about 10 years ago, environmental taxes should be targeted to the polluted, to the ones with polluting behavior. And even, I don't know, 6 years ago, the European Environmental Agency said something like, hey, taxes, I mean, they seem to have achieved such objective at reasonable cost. The only thing that we find interesting is not that you don't find that many papers on corporate investment. And this is where we try to come in. So what is it that we do here? What we try to do is we look at the role of environmental taxes, and we look at the specific one on sulfur oxides and nitrogen oxides. I'm not a chemist, yeah. So if I don't give you all the correct information on these SOx and NOx, I'm sorry about that. And we look at corporate investment decision. We do not look at actual emissions. I can already say that we don't have that information. We would love to have that. If you have some ideas of where to get that, I'm immediately open to do something. But we want to look at corporate investment. Why do we think that this is interesting? Well, corporate investment is a driver of growth, right? And then if you think about this, if environmental taxes at the same time would reduce growth and maybe employment, this would have consequences on the society, right? That we maybe should also consider. And I already mentioned the debate before, right? That there are a lot of countries or government bodies like the OECD thinking about these taxes. How do we do it? I'm not sure if I have seen so far someone from Spain, but we use a very local setting in Spain to begin with and try to look at this. And then we also try to roll this out in an international setting, in a European setting. I see a question by Hafez. He writes that oil and gas companies are amongst those that pollute the most. Taxes on these companies are transferred to final customer by energy and product prices. To what extent are environmental tax and impacts fair on the general public? Hafez, this is an excellent question, and I'll get back to this when we look at the results, because I think you will realize what's going on here. By the way, it's not only oil and gas companies, but let me get back to this, and you will see that the results that we find are very much in line with what you think happens here. So this is what we do. Now, even without thinking of this potential idea of transferring something to a final customer, let's think about something, how theory or some papers think about what happens to investment. Well, one could be a very classical view is that, look, if you increase environmental taxes, they probably decrease investment. Why would that be the case? Well, if you think about this, taxes add to the cost of firms, which increases marginal cost. If you increase marginal cost, obviously, then the quantity that you want to produce probably is reduced. This means profits are reduced, and in the end, you have lower capital that you have. So you invest less. It becomes more expensive to invest. That would be the very simple view. Then on the other end, if you look at especially some literature on innovation, they would tell us it could even be that environmental taxes increase investment. How would that be the case? You would say that, okay, on the one hand, taxes foster competitiveness because you have to adapt to new technology. And if you want to adapt to new technology, I mean, it could be that unit costs are decreased. So there are some papers in that area on this. And then you would say, okay, maybe then you adapt new technology and invest more. So ultimately, if you just put those two next to each other, it would be an empirical question of what's going on here. Now, I can already say later on when we look at the actual empirical study that we run, it might be very hard for us to isolate that second channel on the right-hand side here, because we are limited. We don't really have data on innovation. That is a little bit the problem. That's something we try to work on, of course, as best as possible. Now, coming to the comment that was already in the chat. Sorry, I want to go to the next slide. The question is who actually responds. So what policymakers have in mind and what you might think is that actually the firms that pollute the most are the ones that are directly affected, so they pay the highest tax. So Nathan, sorry for using you now for a case. So Nathan is now the clean company and I'm the dirty one. I mean, Nathan wouldn't care about it, right? Because you will not pay it. You have all the green technology, you don't have any emissions, so why would you care, right? But I'm the dirty company. I might pay it, right? So for me, my profitability is reduced if you think about this, and then the polluters, me, will reduce investment. That's kind of what the OECD, the European Commission, and other bodies think. Now, however, it could also be that it's actually how it was already written in the chat is maybe I have a lot of market power, and maybe Nathan doesn't have. Maybe Nathan is dependent on my input, the product that I produce. So what happens now? I might be able to take that environmental tax, put it on the price that I charge from Nathan, and in the end, I pass on the burden of that tax to the firm with lower market power. So even though Nathan doesn't even pollute, he might actually respond to the pollution tax, or sorry, the emission tax, because I increase my price, because I have the market power. So in the end, it's not a question of who is actually polluting, it's a question of to whom does this tax trickle down? If I'm maybe a polluter, but I don't have market power, okay, it stays with me. But if I'm a polluter and I have market power, then I can pass it on to Nathan. So in the end, the alternative hypothesis here would be, it's actually not related to the level of pollution that responds. It's actually related to the market power or my elasticity as a firm that I have. Yeah, how flexibly can I adjust to this? And if Nathan can adjust more than I can, okay, I will bear the burden. But if Nathan cannot adjust, but I can, Nathan will bear the burden. And then Nathan will be the one that responds to the tax in the market. Yeah, irrespective of whether he's the polluter or not. Yeah, so those are kind of the two things that we have in mind here. We first want to document the main effect, and then we want to document whether it's actually the polluter or whether it trickles down in the market. Yeah, so those are the two things that we have in mind with this. Well, if I want to summarize our key finding, and not sure if everyone wants to listen for 90 minutes, so let's just have the result right away here. So we find that environmental taxes reduce investment. The tax that we study there, you can think about this, that the effect is equivalent to something like a 1.5 percentage point corporate tax cut or increase. Yeah, so it's not huge, yeah, but something apparently happened. Now the interesting thing is, it does not matter whether Nathan or I am the polluter. Yeah? What matters is who has market power and who can flexibly adjust. So we do not see any difference in the response of firms and industries that are high polluting or low polluting. That doesn't matter. What matters is whether you have, relative to your peers, market power or whether you can flexibly adjust. So apparently, it is not the polluter pays principle that we find here. It is really more of an incident story. And what we do is we show this result in a very local setting in Spain. And we also confirmed exactly the same finding using energy taxes in Europe. Yeah, so we use two different settings to find evidence for these two results. This is basically what this paper is about in a nutshell. Now, why would that be important? I mean, one is, of course, I think there's a big literature now on CSR, right? On environmental activities. There's a lot of literature on disclosure and these things. This is not, I mean, there are experts in this. And I think what we do here, what we contribute here is this role of taxes. Yeah? And also related to the CSR cost literature. And I get to the policy implications in a second. But if you think about this, I mean, we have people here who study other types of regulation, who are more from financial accounting and other types of accounting regulation, environmental regulation. And apparently one takeaway, if you would take our result at face value, is that maybe taxes, environmental taxes, are not the best tool to actually hit the polluters. Yeah? Maybe there are other policy actions. Like if I think about the policy toolkit that policymakers have, that they can do. Maybe the environmental tax is not the best option if they want to reduce pollution by polluting firms. Yeah? Maybe that's one takeaway here. And if I would consider this in this whole policy angle, of course, I mean, there is a large literature. And when I have references here now for some things, I apologize to people that I may have missed. There are, of course, several papers on this. So if you think about this, we have a lot of studies on corporations and corporate taxes on profits and how they affect investment. Yeah? It's like really a direct effect. There are also papers on shareholders, the role of dividend taxes in investment. There are a lot of papers. There are papers on value-added taxes, taxing consumers, how that may affect, or on income taxes of the employees. There are also, especially in accounting, a lot of papers on CEO or executive taxation, right? And how this may affect corporations. What we do here is different. We look at green taxes. I give them the name now, green taxes or environmental taxes. But apparently what you see here, it's not necessarily the corporation itself that matters here. It can also be the suppliers or customers that matter. And basically the contribution that we have here to this whole tax and real effects literature would be that, again, it may not be that you hit the polluter. It can actually be that this is passed on through the supply chain. Yeah, reminds me a little bit of the all taxes, all parties framework, right? And Scholz-Wolfson. And this is a classical example here that you try to do something with policy, but you apparently don't achieve the goal, namely hitting the polluters. So this is a little bit, in a nutshell, what we find. Christian.
Yeah, very interesting presentation and paper, Martin. I was thinking, you said that the environmental tax in Spain is similar to a 1.5% corporate tax rate increase. Yeah. And given that there is a wealth of studies, you have a lot of them on normal corporate tax rate increases. Is there anything peculiar about the environmental tax in terms of elasticities? Because I'm not sure if I fully buy your argument that environmental taxes can be passed on, whereas corporate taxes cannot. So yeah, compare your elasticities with, let's say, the other studies.
Yeah, I mean, so let's say comparing elasticities one-to-one is very hard. Also here, what is tough is it's not so easy for us to put a euro or dollar value. This is something where we currently work on to really put like a burden in euro or dollar terms to the single firms, because that's apparently not so easy. Yeah, so what we have started now, what we initiated is a survey and try to find some interview partners in Spain to talk to firms down there, yeah, to really understand what was going on there. And then we can maybe speak more towards that economic magnitude. But basically, I think the key idea is that it's not outrageously large, but it's also not nothing. I think this is rather the key message, but comparing it one-to-one, maybe that was a little bit misleading. I can see that point. Yeah.
Thank you.
Hey, yeah, great study. This is super interesting, and glad that you're looking in this area. I think the question I have goes back a little bit to your motivation when you're talking about the two-sided hypothesis, so whether this is going to increase or decrease investment. And I agree with everything that you're saying there, but I think the thing that is giving me some pause is that some of the effects that you're talking about could be, especially the decrease in investment, seems to be more of a short run effect, that, okay, there's going to be these new taxes, this new tax incidence, and that's going to have this adverse effect. But then you also talked about how these new taxes and this new cost might accelerate innovation and will lead to lower overall costs. But that you kind of play them up to be like they could be simultaneous, but it seems like that second effect, especially the effect that would lead to increased investment, would be more of like a long run play. Yeah. And I'm guessing at some point you talk a little bit about timeline, especially in your analysis and your design. But I was wondering if there is if that's something that you'll need to consider. And then the other piece would be is if there's opportunities to explore the short run effects on investment as well as the long run effects on investment, especially being able to show that there were some initial costs but overall gain from this potential situation.
Yeah, I'm just writing this down. I agree. It could indeed be the case that more in the short run, you more see this decline, and maybe in the long run, this transition in terms of the innovation that this kicks in. We haven't looked at this too much at the moment. I mean, there are some, so one problem is that 3 years after the shock that we look at in Spain, something happened locally. So we would have to think about ways of maybe how to tackle this. But maybe we'll find ways to look at this in the long run. Maybe we'll find different ways of innovation, maybe via patents in the European setting. That could also be one thing, right? That we look at whether at some point that innovation kicks in. Yeah, I agree with you. It could be that maybe these arguments are short run versus long run, and that we are more identifying the short run effect. I can see that. I can see that argument. Yeah. Thank you, Nathan. Hafez, I hope I pronounced your name correctly.
Yeah, you did. Thank you. Just one thing here. First of all, thank you for fascinating presentation. taxes to tackle climate change and emission are varied, as you know. You are the expert here. It's probably it will be key to probably address why the taxes are initially being designed, engineered, and imposed or implemented. Because I'm sure you know about the Pigovian taxes and the externalities, etc. So when we talk about influence and powerful, I refer to the oil and gas industry, and any taxes on their emission will be easily passed to general public. We feel it here in the UK now because energy prices and costs are triple-fold now. But then what's the purpose of the tax? Is it to enhance greener sources of energy? Is it to reduce emission? But why to reduce emission? Is it again to enhance renewables, or is it just to make a new stream of revenues? Then the other thing is the social impact of such taxes. I tried to search the literature. There are few insights, but again, the social impact is significant, and who's paying for it? Now there is one issue here. If and we know about the transition to net zero is happening around the world. Being a bit aggressive on the polluters will be easily passed to the general public. And that's what we are seeing now, reduced demand on oil and gas, obviously is going to increase the prices of oil and gas because reduced demand will be met by reduced supply. But then who's paying for it? So I think addressing the purpose of the tax and then checking the hypothesis of that driver is key for, confirming a result. I'm hoping I'm adding something positive here. Thank you.
Absolutely, Abis. Many thanks. So I think at the moment, also in the paper, we don't write too much about, in general, why these taxes are imposed. Most of the times from what I read is that they specifically say they want to reduce emissions. So in Spain, that was also one goal, is to say, let's introduce that tax to reduce emissions. Yeah, and I think that there can be a goal. That goal is, of course, that is fine, right? It's not up to me to judge that, but I think what is important is to understand the consequences of such an action. And the consequences that we try to estimate in this paper specifically is the investment response. But you're right. If you think about the general discussion, how should we design these taxes? What should we do? And what are the potential effects? Because, of course, oil and gas firms have certain market power. That's a different question. I can see that this is definitely, it's not what we do here in this paper, but I completely agree with you. It's a super important question. And I don't really know any paper that does that conclusively. Let's say it like this, the bigger picture question that you asked. So how should we design basically an environmental tax? I'm not too aware of a paper. If anyone is, please. Hafiz, does that answer your question?
Yeah, it did. Thank you. It's mainly it's a point I'm highlighting. Yeah, I know reducing emission is the target of many policies, including tax policies, but also the academic literature seems to be shying away a bit from what's the alternative. What else can be done? Can the tax revenues from these environmental taxes be used as subsidies to compensate the general public? Or are they actually used, I'm talking about tax revenues here, are they actually used to subsidize or incentivize investment in renewable energy where you can reduce the emission in indirect way? So that's another question. I'm sure one paper won't be able to cover all of these questions, but this can be an angle to your study. Thank you.
That's a very good question. I know that in Spain, and at least that smaller setting, and I know it at least for Germany, for the electricity tax, it just goes into the general budget. So, for example, in Germany, the electricity tax, and it's quite some revenues, it just goes into the general budget. It's not that this revenue is taken and then, as you said, used for very specific purposes like let's be more energy efficient or so. Yeah? But this is something that we should definitely mention in the paper. I completely agree with you.
Thank you.
You're welcome. Then I see a question, Sang-Woo, you wrote a comment in the chat. Again, this is a little bit related to the time frame that Nathan mentioned, right? And I can definitely see that. I think, and we have to be very clear that our results at the moment speak towards the short run response. Yeah, we cannot speak towards the long run response. And I think this is where your comment refers to. So I definitely see. So this is also something, it's a caveat. I show you the timeline later, but it's really the short run response. We cannot look at 6-7 years afterwards, where things may look different. I agree with you. Yeah. But again, then as empirical researchers, it might be hard for us to still identify certain things, right? Okay. So let's probably continue, and let's talk probably exactly about the type of policy that we do here. Namely, let me just write down the comment. The emission taxes in Valencia, or in the autonomous region of Valencia. Not sure if anyone here ever been to Valencia. I have been. There was the EAA once, the European Accounting Association conference was there. It was, Nathan, you hope agree, it was very nice. Back then, I didn't know that they have introduced an emission tax that I will study a few years later. Otherwise, I would have asked locals. Yeah? So what happened? In the year 2012, they, on relatively short notice, announced that they will pass an environmental tax on SOx and NOx emissions. And the idea here was, again, as I said, to reduce these emissions. You have to see that in Spain, there are local taxes, right? The autonomous regions can set local taxes. Other regions already had such a tax in place. Valencia and, for example, Catalonia, not. Yeah? They did not have these in place. Now, it was apparently not really expected from what we have read so far. And I can say that it's not so easy to find local newspaper articles. Yeah, we have the law, we have the argumentation and these things. And where we work on at the moment is to look for anecdotal evidence from really the local area, right? Basically the press coverage by the very, very local newspapers. And it would be, I don't know, Nathan and Raleigh, the Raleigh Gazette, instead of the, I don't know, the Washington Gazette. Yeah, it would be really very local newspapers, but it's not so easy, and my Spanish is not existent. So that's why we are currently working on that front. Yeah? The good thing for us is that the law actually, when it was announced in 2012, was set into place relatively quickly in January 2013. The other good thing is that basically until December 2020, there were not really changes to that emission taxes itself, yeah, which is good for us. They were like really just minor amendments. So this is what we do. Then we use that setting. We use that setting in a classical diff and diff. What you see here is a map of Spain. Yeah. And what you see is this area here in gray. This area here in gray has two parts. One is here along the coast. This is the autonomous region of Valencia. And our control group will be very, very local. And then we even focus a bit more. We compare the two regions of Alicante and Murcia. So it's very local. Yeah? I mean, this is really very, very close to each other. And I'll show you some statistics on these two regions. And ultimately, very, very simple, what we do here is, let's compare the investment activity in Alicante to the investment activity in Murcia. To put it very, very simple. Now, question, of course, is can we compare those two regions? And let me try to convince you that this is possible to do. So first of all, Murcia looks very nice. Coastal area, but Alicante also looks very nice. Yeah, so both apparently are very, very nice places, but now come the important things. If you look at the economic development in these regions, those are the unemployment rates. I mean, they are very high. Yeah, this is in Spain, unemployment rates are above 20%. Yeah, the official unemployment rate. So that's why But what you see is that they move relatively parallel. Yeah? So it's not that they are completely off. But you also have to see both regions are for Spain relatively important. So they contribute a sizable share to the overall Spanish GDP, just those two regions. Yeah? Industry-wise, you can see that certain sectors are, I mean, they are not exactly the same. I see, I mean, it's very hard now to know what is AA is, for example, agriculture. And then BDE, this is the European classification. You could think about them as like SIG-1 codes, yeah, with of course different sortings. So you see that, yeah, it seems like there might be some differences, but we'll try to take care of that. Yeah. Then population, yeah, both have about more than or roughly about 1.5 or 2 million population, just those two small regions. So we are not talking about regions with no economic activity. So what we would say is that those two regions, and I'm sorry for the small text here, that those two regions are comparable, yeah, in terms of the socioeconomic conditions. They, of course, not exactly the same, but we at least think that they follow the parallel trend. Yeah. And now, when it comes to investment, of course, what matters is that in the 3 years before something happens, there is a parallel trend. And this is what we see. So in the years 2009, 2010, 2011, it seems that investment of firms local in Alicante, the treatment group, and in Murcia, they follow very similar paths. Yeah. And then forget about the right-hand side for a second. What we do is we run very simple regressions, diff and diff, and we always find that investment declined in Alicante, the treated ones that are subject now to the emission tax, relative to Murcia. Now, what is important here is this result shows up irrespective of whether we include any controls of or firm fixed effects or whatever, just basically comparing raw data. That's column 1. In column 2, we start adding industry year fixed effects so that we have a comparison within the same industry and controls. And then one step further, we include firm fixed effects. Now, what is important, I think, for us is it's not that the it's not that the coefficient estimate changes dramatically here. Yeah, so it doesn't seem that adding these variables changes a lot. Then, what is it basically done in columns 4 to 6? We replicate exactly the same approach without controls, with controls, and some fixed effects with more fixed effects. But there, we use an entropy balancing. So we now say that, hey, Nathan's firm in Murcia is, of course, on average, a little bit bigger, maybe, or maybe more profitable than the one that Christian has in Alicante. Okay, so let's balance them. Let's have them before the shock. Let's have a similar sample of firms. And let's repeat the same analysis. And it doesn't seem that much happens to the result. So it looks like this is relatively robust, that one. Yeah? Then the next thing, basically maybe related to the timing, we can see that, of course, in 2012, when the reform was announced, nothing happens, but then something happens in 2013 and 14, and it seems like the effect is getting a little bit stronger. The reason here is very simple. It takes some time, right, to adjust your investments. The other thing, now, why do we stop in 2015? Well, Murcia announced in 2015 a tax reform, the personal income tax. It's not emission tax related, but something happened tax-wise in Murcia, and that's why we don't continue it. I mean, we could try, but we were a bit hesitant, but probably we should think about ways how to get more at the long run and write down that this is really the short run response that we have here. Yeah, in this test. Now what we do is basically we run a bunch of robustness tests. Yeah. First of all, what we do is we expand the sample. What do I mean by that? What I mean by that is we include more groups. Remember the map in Spain, we just had these two regions very close to each other. But now what we do is we broaden it. We take the whole autonomous region of Valencia and then take a broader area around. Results remain robust here. Yeah. Then the next thing is we run a placebo test. Now consider, I have Peter, you are also next to my picture. Yeah, sorry. So I use you also for an example here. You have these 3 regions. So let's say Peter sits in Valencia, Nathan sits in Alicante, and Christian in Castellón. So what happens now is you are all subject to the same tax, so there shouldn't be any difference. So if anything flunky is or anything crazy is going on in Alicante, our actual treatment group in the first one, but that is not related to the emission tax, well, then we should see a difference between Peter, between Peter, Nathan, and Christian. But we don't see that. And you look at the coefficients, they are really like zero, right? They're really small. So apparently, irrespective of where you are in the region of Valencia, so in the city of Valencia, I'm sorry for the confusion. Yeah, you have a region and a city named Valencia. Whether it's wherever you are, the response is the same. So this was comforting for us, yeah, that it's nothing going on in that one area that we have. And what we also did is basically ran a placebo test everywhere else in Spain, where we had pairs of smaller regions located at borders. The green ones are excluded not because we don't like them. The green ones are simply excluded because they don't border any other state. You could think about it. Yeah. And Soria, I'm sorry about that the sample is just way too small. This is the smallest region in Spain with the lowest number of firms, and you cannot reliably use it in the regression. And we ran this for placebo test. We don't find any significant result anywhere in any of the other regions. So it was really specific to Alicante, what was going on there, yeah? Or Valencia, you'd say. And then we also run some other tests with different dependent variables or with alternative clustering if people are concerned that we made some poor choices there, and whatever we do is nothing changes. And what one analysis that I found a little bit more important for our setting, remember we have a private firm setting here. That means we have some potentially also very small firms in there. And if my firm with, I don't know, $200,000 of assets changes investment, policymakers might not care so much relative to Christian's firm with 5 million total assets. So what we do is we do a weighting by by assets. Yeah, we give more weights to larger firms than to smaller firms, and nothing changes here. Yeah. So ultimately, anything that I've showed you so far is on that average response. So apparently, the introduction of this emission tax reduced investment. This is basically what these results tell us. Now let's think about the question, and this is how we try to test the polluter paste channel. So one limitation, of course, of our study is I have no clue what a single firm emits. Right? I mean, I don't know that. We don't have any tax information. We don't have any secret database on that. But what we know is whether a firm operates in an industry that is likely more or less polluting. Yeah, so basically what we now do is we take the NACE, that's the European standard in the industry classifications. You could think about this as SIG2, the equivalent in the US, or NACE code 2, the 2-digit industry code, and use data from Europe on pollution. So how much do firms on average in an industry pollute? And then we sort industries into high polluting versus low polluting. So basically, this is what we try to do here. So here we sort firms into industries that have high sulfur oxide emissions versus those with low sulfur oxide emissions. And then we do the same with nitrogen oxide. And what you see is, especially here, this is a good example, it does not matter whether you are in the low or in the high emission industry. Your investment response is just the same. Yeah? There is no statistical difference, and if you look at the coefficients, they are very, very similar. Yeah, so apparently it doesn't matter whether Nathan now is in an industry with more pollution or not. The response is the same. So it doesn't really seem that we find support here for this polluter pays principle. And by the way, irrespective of what cuts we tried. Yeah? I mean, this is just one result here. We tried different things, quartiles, whatever. The result is always the same. Yeah. Okay, then we thought differently. We looked at who might bear the economic burden. Now, of course, this is super hard to measure. I mean, I know that there is never the perfect measure to get at this, but we looked at this from two angles. One is building on the learner index, the pricing power in the market. So let's just look at margins, profit margins. And they might inform us about whether you have higher or lower market power. And then on the other hand, we looked at the availability of internal funds. So there is this very, very nice literature review, already 20 or 35 years old almost, but it very nicely summarizes the tax incidence literature. And there I like one quote, and they say it's Larry Summers is one of the authors. They write, taxes are borne by those who cannot easily adjust. I mean, remember we have private firms that we don't have great data in terms of financial statements, but what we have is we know the availability of internal funds. So the idea is that firms with more internal funds, of course, can more easily adjust, right? They can change their investment program and so on, whereas firms with low internal funds can hardly do that. And this is exactly what we now find is that firms with either low profit margins or those that cannot easily adjust because they don't have the internal funds, they are the ones who cut their investment program. They are the ones who respond to it. Yeah, so apparently it does not seem to be the polluter, but more the ones that bear the burden in the end. Yeah, building on these measures are basically built on prior literature. I don't have all of that here on the slides, but it apparently does not really support what the OECD and the European Commission and the European Environmental Agency had in mind. Yeah, at least if you buy the results. Any questions on this? Because if not, I would maybe show you some of the results that we had for the larger sample, the broader setting. And basically what we did here, we used exactly the same approach. Again, we use private firm data from Amadeus. That means we use firms where we know that they operate only in that country, right? If I would now have a multinational, I don't even know where the footprint of that firm is. So I don't even know whether a German multinational is actually paying taxes in Germany or elsewhere. So that's why we focus on unconsolidated statements of local firms, because there I really know that they operate there, so they pay taxes there. So what we do here is now, let's replicate exactly our results, but let's use the changes in the electricity taxes in Europe. So Europe has, depending on the country, relatively high taxes on electricity consumption. Yeah, what we don't have here in the sample are the electricity producers. Yeah, so let's be very clear. We don't have the producers of electricity. We only have the consumers. So the entire industry, where we take out specifically the industry code of the electricity producing firms. Now the nice thing is that they are very important in terms of revenues in Europe, these electricity taxes, and there's a large variation in the tax rates. So just to tell you, across the European countries, you see that these electricity taxes change relatively frequently. So some countries like France had staggered implementation step by step. They phased in an electricity tax. Other countries had like a one-time increase, big jump in these electricity taxes. So this is what we do. And when we do that, let's start maybe with the one up here. We can show that changes in the electricity tax are associated with lower investment. So the same direction, right? Same effect. Then what we did is we split the changes in electricity taxes into increases versus decreases. One caveat already, there are not too many decreases. Yeah. What we see here is that apparently around the increases, yes, firms responded, right? Around the decreases, not. And I'm actually not too surprised by that, because given the trend of increasing electricity taxes, I don't think that companies change their opinion on the long-term nature of that cut. They say, yeah, maybe it goes down in 1 year, but I expect it to go up again in 2 or 3 years. Yeah, because given the European initiatives and all that. So that's why I'm not too surprised that we don't see anything with the decreases. When it comes to the timing, again, there is no response before, and it, in this case, takes a little bit time, 2 years, to respond to that tax. Yeah? Again, going to the short-term versus long-term nature, we didn't try many more years. Yeah? We can see what happens. Maybe then you see that going up. I like that idea. Yeah? Then maybe for the ones who like identification, we also tried, because that's ultimately a staggered diff and diff in some degree, yeah, what we did here. And we did also a stacked diff and diff, so we look at isolated events, replicate everything, and find very similar results. Yeah, so apparently in that international setting, the results are fairly robust as well. Now, what we then again do is we again compare the firms that may consume a lot versus not so much of the electricity. That means we again try to assess the polluter pays principle by sorting industries according to the level of their energy consumption, again, based on aggregate European Union statistics. Yeah, so those are really the consumption of the firms in the European Union. Again, it doesn't really seem that it's the high consuming firms that respond more. If at all, it's Nathan who tried to save energy. Yeah, but then what happens? You can think about what happens. Yeah, Nathan got it passed on from me. Yeah? It's the firms with the low margins that they cut their investments more than firms with high margins do. Again, when replicating exactly the same finding with the split by internal funds, we see the same pattern. Yeah, the ones that have low internal funds, they don't respond, but the ones with high internal funds, they respond. Though here in this case, the difference is not statistically significant. But it goes in that direction of what we showed in the Spanish case. Christian.
And Martin, this is very interesting. Can you go back one slide maybe?
Absolutely.
So this kind of surprises me, because by your story that it's not the polluter pays but the incidence channel, but then this may also mean that the low energy consumption firms have lower market power or something, because if you would assume that both the low energy consumption and high energy consumption firm would have similar market power, then you would expect similar effects.
Yeah, absolutely. I mean, now that you say it, maybe one way would be to put those two in the same regression, right? So maybe it could be that there is a systematic sorting, right? That the firms that may have low energy consumption are the ones maybe also with lower market power, right? This is what you're saying.
Yeah,
could be. Yeah, maybe to tease that out more, maybe it would be good to control simply for both. That would probably solve that issue, right?
Yeah, it would, because now it seems like if Nathan is the green firm and I would be the dirty firm, and we would have similar market power, we would be similarly able to shift the taxes. So if I would shift it to Nathan, Nathan could shift it to the next firm in the supply chain.
Yeah, I like that idea. I'm writing this down. This is a relatively easy test to do. Yeah, I agree. This is not perfectly in line. Yeah? Okay, I mean, basically what this is, I mean, the paper, we can extend this paper, I think. Of course, we can always write much longer papers. Yeah, I know, Peter, I think you have seen more papers than any one of us here, and I know that there are other people handling papers here in this call, and the paper is already relatively long in terms of pages, 50, I think we are already at. But of course, there are way more ideas and way more things that we can do. I mean, I think that the results that we have, we try to make it very simple, is that yes, apparently environmental taxes reduce investment, but it's not the polluter. It might be related to market power. Of course, there are still many open questions. Yeah, what happens to innovation? What is the long run effect? Could it be that there is maybe also a shift in the industry composition? Yeah. So I think there are many open questions, and I think that there's more research to come on environmental taxes and these things, given that they become more and more important. But we try to focus on these two messages at the moment, but I guess more by whoever ideally comes, right, with respect to this, so that we understand a little bit more how environmental taxes and regulation in more general affects the business landscape and innovation, and in the end also output in society, right, to make it even bigger. Yeah? But we try to focus for now on corporate investment. Yeah, and of course the carbon bubble and environmental taxes, that of course is a very important question, which I cannot answer right now, but Nathan, please.
So I think one thing that I think naturally comes out, and of course this is like a little bit in contrast to the paper already being kind of lengthy, so feel free to ignore it if it just doesn't fit well. But the idea that you look at how this affects their investment is really interesting. But I was also thinking about these other kind of more broader consequences that these firms might be facing. So for example, if there's a smaller, more constrained company that is being subject to these taxes or has to decrease investment because of these taxes, what's the implication to that firm in terms of their prospects? Is this and maybe putting into a broader perspective, do these taxes have the ability to remove companies from our capital markets and take them out of business? Is this something that, and I think that's where it maybe gets a little bit more policy oriented and can kind of show some of the real, like, I'll call it almost like disastrous effects that, carbon tax in itself can be enough to bankrupt or put away a company or require the company to then be acquired by a competitor. Now, those are some extreme events, but I think those are the ones that like maybe a more policy oriented person would be starting to think about it and see as like a really big effect, because, maybe a lowering of investment can be somewhat tough, but then if it's really detrimental to the company, is that something that y'all can potentially speak to either in this paper or maybe in just a future paper?
Yeah, I agree. So the idea maybe results in removal of firms, or you can also put it positively, if it incentivizes more startups, more innovative startups. That could be also kind of the flip side of it, right? And then, ultimately that would have implication on the industry composition or industry concentration. So market, how it shapes the market. Yeah, of course. I like these ideas, especially the idea of maybe it fosters startup and innovation. Maybe not in the existing firms, but maybe it fosters market entrance. We don't know, no?
Yeah, definitely. And I could even see that as essentially you're removing some of the more like problematic firms when it comes down to environmental carbon emission type things, and you incentivize companies that are going to come in and from the beginning be a green based company. I think, kind of that composition, and it sounds like that would be more of a different paper, but it's definitely something I think that could be really interesting.
Yeah, because here's how I can see that, Nathan. It's like, on the one hand, it might be that here, even if we don't find that the polluters, let's say, cut investment and cut their economic activity, but if this would, so maybe that's not a desired effect. It's like, it sounds almost like an unintended consequence, right? But if at the same time you foster innovation and new firms come in, and maybe this could kind of balance out a little bit that unintended consequence, right? If you foster new startups popping up and thinking about how can we save energy, because they don't face this cost ultimately. Yeah, I can see that. As you say, that might actually even almost be a different kind of study. It's like, okay, here's a hunting ground, the first start, but then look at industry composition, look at these things, could be very interesting. And Europe offers some, let's say, some variation in these taxes. I'm not sure about the US. There's really an honest question out to you. Is it state level based? Is it all federal? Would you have some variation in the US as well in these types of taxes? I see Peter nodding. Yeah. You have state level corporate taxes, state level personal taxes. I'm not sure about the environmental taxes in the US.
I think if anywhere, it would be like California that would have something like this. But yeah, in North Carolina, we're all about whatever. So, we'll see. But there is probably some good variation between them.
California has the highest rate just in everything, right? Yeah, okay. That's interesting. Basically, I said almost everything that I wanted to say, except for thank you for Mohammed, for organizing, for all the comments. This is really helpful, and I hope that you enjoyed it.
Thank you very much, dear Professor Martin Jacob, for your contribution and your effort. It's really an excellent presentation. Thank you very much. If anyone have any questions, you can open your mic and ask your question. If anyone have any questions, you can open your mic and ask your question. Angie, Professor Angie, you have any questions? Thank you very much, dear Professor Martin Jacob. And it's all that remains for me to say is thank you everyone that joined us. And I thank you very much for taking the time out to present to us today, dear Professor Martin Jacob. It's been really appreciated. Thank you very much.
Thank you.
And I hope to see you soon in Egypt, dear Prof. You are very, very welcome.
That would be great if we all can travel again.
Yeah.
Without.
Goodbye.
Goodbye. Bye, everyone.